Last week we were here with 5,000 of our closest friends in the same building. So I got to know the building pretty well. So sorry if you guys got lost. But this is the keynote I did. Um, I wrote it before the election, so I'm not sure how much bearing this will have on economic policy. But I'm just going to spend the next 20 minutes or so um, giving you data. I've always been a self-described data nerd. For the ones that don't know, Ariane and I co-founded ReveMine. So raise your hand if you've heard of our software or use it on a daily basis. And I just believe that data sets you free and gives you context. So all this is data. If you're an agent, the way you should look at this is how do you serve the customers you work with every day and how to take advantage of what's going to happen. I normally look for what I call directionally accurate movements in data. What's an eventuality? What's going to happen regardless of my feelings, my emotions? I think, a week in politics is a very good point because half the country's mad and half the country's happy. But I normally say, okay, put your feelings aside and just where you can see that things will happen and trend. So the first thing that I'll point out is somehow the economy has continued to grow, which is kind of crazy because every prediction was that we would be in a recession by now. This is being completely fueled by consumer spending. So consumers are still spending more money than we predicted. That's the good news. The bad news is that we're now touching the highest consumer debt in the history of the world. So it's about $18 trillion worth of debt. The good news is that most of that is mortgage debt, which is fully underwritten, and it's offset by about $35 trillion worth of equity. But in that 18 trillion, there's like 1.5 trillion of credit card, 1.3 trillion of car and school debt. So the thing that you need to take away as a realtor is that even if you sold somebody a house 3 years ago, you should be talking to them. There are people getting themselves into financial distress right now who probably won't look like the financial distress of 2008, 2009, 2010 that you picture. So it's really important that you stay in touch with all of your past customers and you're just sending them CMAs, right? Sending them updates as to the equity in their home. And I'll talk about that a little bit later on in the presentation. Unemployment is still good. We're still sub 5%, which historically we're sitting between 4.1 and 4.2. But if you look at most economists' opinions, anything be sub 5% is considered full employment in this country. So again, a very important indicator. When you look at the affordability and the health of the real estate market, you're normally looking for employment, affordability, and also cost to finance everything. So inventory and affordability is super important in the calculation. So the Fed has cut the rate, and again, I wrote this 2 weeks ago. They cut it again last night. Most people forget that the actual Fed rate is not the biggest indicator of mortgage rates. It's actually the 10-year Treasury. So, but rates have come down. So if we started January 1 of this year, where they were to where they are, rates have come down quite a bit, which is healthy. So even if they stay steady for 2025, it's putting us on a much better trajectory than what we've been experiencing for a while. So you could see, and again, for the folks in the room who felt like 23 and 24 were a fist fight, it's because they were, right? We had the highest interest rate spike in the history of the United States. You can see it right on that chart. The speed at which the rates moved has never happened in the history of this country, right? So if you've ever been on a Zoom with me, I was wearing my hat yesterday. I wear a hat that says context right on it. I say it's my favorite word in the English language. And data makes you have context. So anytime I get in front of agents, our agents, I remind them, it's like, hey, right now, surviving is thriving, right? We're probably on track, and I'll touch it on this slide. This was, I think this is an August number. It was the 36th consecutive month of less transactions than the previous month, right? That is putting us on track to about 3.8, 3.9 million transactions in 2024 of resale. Do you guys know when the last time we had a year that bad was? 1995. It's the worst year in real estate from a transactional unit count since 1995. So again, if it's felt tough and it's felt like a fist fight, it's not you. It's the total market. 2023, we did about 4 million. So we're still below that. New construction is the kind of bright spot on there because, and I'll talk about it in a little bit, but just understand that transactions are way down. Now, the good news is year over year, we're up like 34% in inventory. So inventory is coming back. And again, when I say that, I always remind everybody it's hyper local, right? It doesn't mean because you live in northern Florida versus southern Florida versus central Florida. It's completely different. If you're in Ohio, it's very different than Texas. And what we saw were the boom towns post-COVID are the ones in the most trouble. So like Boise, Idaho, and Tennessee and Austin, Texas, that had these crazy runs are starting to actually see decreases in value, which again, parts of Florida are seeing that. South Florida still has a lot of demand, although we're all starting to see some stuff sitting on the market. Condos are taking longer to sell. But the good news is if we have inventory increase, that's a really good thing. With the rates coming down, we're starting to see pending sale increases. So it tends to be an early sign of recovery, but again, to be determined as 2025 unfolds. The mortgage rate decline is super helpful. If you were a loan officer, it was more painful for the last 2 years than even for realtors because refinances pretty much got wiped out. Do you guys know what percentage of homes have a rate 5% or lower? 84%. 84%. So when rates come down, it does two things. One is it helps buyers get off the sideline because there's always a portion of buyer population that was sitting who literally have a lease. They're a younger family. Right now we have 18,000 people turning 35 every single day. It's an important number for you guys to remember because that is peak buying year, right? That's when you fall in love, you make little people, you need to move out of the 1-bedroom or 2-bedroom into a townhouse or a starter home. And those people don't have to get rid of something. They're not rate locked in a house. And so those are the ones that are most sensitive to interest rates, right? Because I'm paying $4,000 a month in rent. My lease is up in 60 days. Can I get something equal to or greater than or adjacent for the same amount of money? And that's the people you need to focus on because the sellers this is a fun exercise. Everyone look around. Raise your hand if you have a rate below 3.5%. Right? Are any of you selling to trade it for 6.5? So when I talk to agents, I say right now is work with the people who have to move, who have to sell. Loan applications are up. So again, for loan officers, this is a huge reprieve. Again, and especially people who got rates at 7.5%, 8%, they're probably going to want to refinance in the next couple months. Inventory of homes, again, I said is up 34%. It's still below pre-pandemic levels. So we're still not back to a normalized market, right? And again, for context, the most homes ever sold in any given year is about 7 million, which happened twice in my career. One was 2021 and the previous one was 2006. The lowest homes ever sold have now happened in 2023 and 2024. But before that was 2008, 2009, and before that was the early 90s. So a normalized market should feel like 5 to 5.5 million homes. So we're nowhere close to that. So inventory levels coming up is a good thing for you guys. And supply level is back to 2019 numbers in some states, right? So not in all states. And again, this is where being a local expert is very, very important. And there's a very strong correlation between low inventory and appreciation and high inventory and either flat or decreasing price points. And this, again, as an agent, that's where you bring the most value because you're a local expert. And you can even see it like on a heat map, right? In the previous slide, it looked like Florida and Texas were one way, but if you zoom into Florida where we live, most of us, right? I know some of you flew in for this. Lots of Florida is starting to have inventory buildup on the West Coast and in central part, but southern Florida still has a ton of demand. Now, this is an interesting bright spot. So historically, new construction makes up between 10 to 15% of every home sold in this country. Last year, 2024, we're on track to do 700,000 new construction units, making up 20% of every sale in the US, right? That's a huge piece of the business. So again, depending on what it is you do in this room, but if you're an agent, New construction right now is a very good place to find inventory for a couple of reasons. One is they're being very aggressive on pricing. New construction is down 10% peak pricing from post-pandemic. So if homes were selling for X, we're actually selling about 10% below peak pandemic pricing, even in markets that have appreciated, because builders have done a little bit of shrinkification throughout COVID as well, where they're just building smaller footprints to stay in the affordability range. And also, in most parts of the country, I don't think Florida quite so much, but Texas and other parts, new construction is almost the same cost as resale, right? So they are being very aggressive. And lastly, they have a lever that most homeowners don't employ, but you should probably educate them on, where they're doing seller bought buy downs, like a 3-2-1, where they'll buy down the rate for the buyer as part of the offering. And that's a very interesting way to use concessions to get buyers to buy your properties. So if you're not working with new construction builders, make sure you're doing that. And this is also really good news. And I do this presentation every year at EXPCon, and what I told everybody in the audience last week was, this is mostly good news. Last year it was mostly bad news. Like I was like, 23 sucks, and by the way, 24 is going to suck. But 25, I'm feeling bullish on. One is we have housing starts and payments, and housing starts and permit issue have continued to rise. So this is a good thing for new construction, and so I'm feeling bullish about it for next year. And demographics is what's most important. I said 18,000 earlier, it was 12,000. So the demand by buyers is driven by demographics. A very good example at the global level, and we operate in 24 countries, so I have a very global perspective, is Japan. I don't know if most people know, Japan is suffering from a bubble bursting of population. So in this country, we have about 94 million residential parcels, and we have more families than households available for them. That's why we're short roughly 4 to 5 million, depending on which economist you ask. Japan, on the opposite, has 68 million pieces of real estate with only 60 million households. They actually have a balloon of vacant property. It started in the suburbs and the rural parts, but it's now moving into Tokyo and other internal parts. So this is a good thing. We want population expansion. We want population growth. It's what drives the economy. For South Florida, this is not a surprise, but Latinos are driving household formation in the United States. 7-1 per the last census compared to most other groups. They're the fastest growing demographic. They cohabitate and create households faster, and they have more kids, statistically speaking. So this is just purely demographically driven. And Hispanic homeownership is substantially lower than the average compared to their peer groups. And that's mostly because it's the youngest demographic. So again, I bet on eventualities. So if you're not Latino or don't speak Spanish and you have a team and you're in real estate, I highly suggest you hire some young folks who do, so you can capture that business as well. We operate in multiple countries, and Canada is our second largest market. So this presentation was for all my people, and Canada market's tracking ours. Interest rates have come down, inventory levels are normalizing, and Canadians were just as happy as my American agents. I'll skip over Canada, but commercial is interesting as well. We have a commercial division. I have close to 1,000 commercial agents in 50 states. And they were just as happy to know that our data says the commercial market's bottomed out. They probably got their butt kicked harder than we did in the residential space over the last 2 years. But both in price drops, multifamily office, we're starting to see bottom out, except really urban core markets. Rents are starting to stabilize. Again, this is after 2 years of quite a brutal beating. So most of the time when I say this, people think I'm off, but this is starting to bottom out. So the interesting thing is, in commercial real estate, it has come to a complete stop of new construction for apartments. Again, that doesn't feel quite what we see out with the cranes if we look outside of the conference center, but the amount of new apartments and condominiums being delivered will be delivered and then absorbed, and then we'll probably go through a 2 year, 3 cycle where it feels like we had too much inventory, and then we will not have enough inventory, and then they'll start all building again, because markets are very cyclical and in a very herd mentality. And that's about it. So I did it very quickly. I actually left a couple minutes for Q&A if anyone wants to dive into any specific questions. But um, basically, my prediction is, and mine coupled with the economists we pay a lot of money to. I just did our earnings call yesterday, and what I said to our analysts is, based on all the economic factors, we think there's going to be about a 10% increase in transactions next year. So we're hoping to have 4.5 million resales with at least 600,000 or 700,000 new construction closes, which puts us in that 5 to 5.5 million range, which will feel a lot more balanced and normal, which we haven't had in a long time. So we kind of do this in real estate. It never feels quite normal. It only looks normal when we look back on a chart in the past. But if there's any other questions, I can answer them now, or I can give the microphone back. Good morning.
Come from Mesa, Arizona.
And I'll repeat the question. So
And there is a huge boom with a lot of the tech companies coming in. Facebook, actually in my neighborhood, is putting in a data center that is bigger than Macy's on Herald Square in New York City. So with that, you see, and apartment buildings are going up, which there is new construction, of course, that comes with huge amounts of new communities. It was interesting that you said about because it seems as though the houses, the single family residences, communities, almost to a screeching halt, and now all of a sudden that's exactly what it is. They're uh, apartment buildings going up, and not just near the where the data center is going in, but in more of the outlying areas as well. So, how do you think that the influx of those types of like the data centers and the change in Intel and Lucid Technologies actually too in our area is building a new facility? How do you think that that's going to affect those types of markets?
yeah, so that's the fun part about real estate. It's hyper local. So most markets have some driving indicator that drives that local economy. And so what you'll see when you look at something single families versus apartments, apartments are a cap rate income ratio based on cost of money and demand. Last 2 years, cost of money got very expensive, right? So I actually had lunch with a developer in Miami the other day who's like, when we underwrote this, capital was this. Now there was no demand for institutional capital. So um, if you have the right economics, people will build. If they don't, they won't. And the supply demand ratio, especially for single family homes, is a little different. And again, not to pick a side of politics, but we saw both candidates talk about, like, I'm going to fix this. Bullshit. Neither one of them can fix it. We have a structural problem at the municipal level, not the federal level, right? The reason we haven't built enough homes is because post financial crisis, um, a bunch of counties went bankrupt, and they came up with these taxation forms to raise money in the way of impact fees and tap fees. So like I can go to most markets and buy a lot for a dollar amount that makes sense and build a house at, $1 per square foot that makes sense. But you throw in a $30,000 tap fee for the sewer and an $80,000 impact fee for the schools, and it no longer makes sense. The only way you can put in $110,000 of added taxes is on a $1.6 million home, right? So that's why, whether it's South Florida or Texas or Mesa, Arizona, you only see new construction in that very expensive range where $100,000 can be put in, but like in affordable housing at $350,000, it's almost impossible because it wipes out the equity.
So I would we're all about technology. Do you think, what's your opinion on tomorrow's or actually today's agent? Do they have to step up? They have to invest in their brand and reputation. Do they have to invest more in technology, embrace technology, stop being afraid? We had really cool presentation this morning about AI. It was an eye opener for me. I need to step up my game, but it's really in my opinion, that is the time for someone not just to survive but thrive, or
Yeah.
you just
No,
get
no,
there.
it's a great question. And so I'll answer it in a different way. I've been licensed 23 years. I was a broker of a Keller Williams office when I was 23. And I remember actually debating with an agent about getting an email address. Like she was like, I don't know if this internet thing's going to stick. I'm just going to stick to the facts and my landline, right? I've seen two ginormous leaps forward as an agent. One was the internet, and then the other one has been the internet on my phone. The first, the internet was like, I don't no longer have to drive to the office and like sit at this portal that does this to give me some listings, then print them out and make calls. I could do it from home. I could do it high speed. That's when like Matrix and all the systems that you're familiar with came out. And then like about 4 years later, we went from the Nokia phone to an actual smartphone, and that really accelerated. And what, like, if you've been licensed long enough, it's the speed at which you can do transactions. So 25 years ago, it took 5 days to get an offer, right? Because you'd list it, you'd get some calls scheduled, and then to get an offer presented, someone had to fax it or drive it over to your office. Now it can be live in an hour, right? Like it goes on and goes syndicated. You schedule the time with showing time online. You write the offer on a technology platform and deliver it within an hour, right? You can literally get 10 offers if you price the property correctly on a Friday. The way I feel about AI is the exact same way. The agents who adopt all these tools will be faster, stronger, better than the ones that don't. So it doesn't matter what shift we're seeing in society. I would always encourage everyone to taste and try and touch and feel. It might not have an impact today. Like when the smartphone came out, it wasn't revolutionary, but now it's like the remote control to your life. Like if I were to take this away from you for 6 hours, like none of us could get home, call somebody, buy food on the way out because it's now our wallet. Like this thing is the key to my car and to my wallet now. So that's, I'm all out of time. Thank you so much